So over the last 3 or 4 years, robo-advisors have been all the rage. The effort to keep fees low, match market performance, and really be a substitute against archaic ways of investing such as actively traded mutual funds. However, there are 3 major things that robo-advisors cannot do for you, and this is not even including financial planning, advanced tax strategies, and other financial advice that would come from a professional. But simply on the investment side, there are 3 main things that your robo-advisor will not do. And number 1, it will not allow you to participate in illiquid assets. So what that means is those are alternative assets such as private equity, private debt, and private real estate. And so because of this illiquidity, which means that you can't readily sell them or transact on them, similar to say selling RBC stock, you actually receive a premium to have liquidity in the market. So anything that is publicly traded is going to be a higher valuation or a higher cost, which means you are paying a liquidity premium. Conversely, private equity, private debt, private real estate, you will pay less or a lower premium or no liquidity premium, which means that because your investment is based on the series of cash flows from that investment, you want to pay a lower price. And that's where the private alternatives come in. Very few, if any, robo-advisors allow alternative assets in their space right now, and that is really one of the most important things to consider for a portfolio. So just understand the Canada Pension Plan, the Yale Endowment, OMERS, the Ontario Teacher Pension, all of these historically good performing pensions and institutional accounts all have 40, 50, and upwards of even 60% in alternative assets. So why would you not want to do that yourself and have that similar success? Number 2, they are not usually going to allow you to purchase non-correlated assets such as long-term US Treasuries or, again, private alternatives in your portfolios through your robo-advisor. Now, why is that important? Because when the market sells off significantly, like we saw in March and April, and could be around the corner depending on how we come out of this pandemic, is that when equities are sold off sharply, these non-correlated assets come in to actually lift portfolio values and protect capital. And although there are bond funds, there is a big difference between owning a very non-correlated fixed income security such as a long-term US Treasury and owning a short-term corporate bond. The third thing is that, and we've touched on this in previous videos, structured products and different solutions that you can use to capitalize on recovery and performance simply are not going to be available through robo-advisors. In fact, today we received pricing on the low volatility index ETF ZLB. We are able to accomplish a 455% upside on that security over 7 years with the same 1-to-1 downside risk. So for anyone that is choosing a robo-advisor because they want to outperform the market, I will almost guarantee that there is not a portfolio that they will offer that will beat the market by an additional 355%. It is simply not even possible. And those are the types of opportunities that you are just not going to get with a robo-advisor. However, let's talk about the reason when you should have a robo-advisor. We're not going to rain on their parade because they're very viable and they are very good for individual investors that are starting to accumulate capital. But if you have over $25,000 of capital, you're better off finding an advisor or an advisory team that will actually be able to have you participate in these assets, because you're going to do a lot better long term than just actually using a machine because of the omissions that they have within their offerings. Robo-advisors are a great innovation in our market. However, they do have limitations. So make sure that you get educated and understand the pros and cons of both. We've uncovered a lot of the cons. Obviously the pro is it's a set it and forget it system. They're great for individual investors that are just starting to save capital, But for people that have a lot more assets and want a more sophisticated approach and better upside and better asset allocation potential, then considering a private wealth manager is going to beat a robo-advisor almost 9 times out of 10.